Today we start with step number 3, the end game. And before we move forward, let's recap yesterday's video from a macro level to make sure we're all on the same page. The first thing we have to remember is there's two completely separate markets for the dollar, inside the US and outside the US. The Fed, the government, can print all of this funny money, spend it into the economy. The supply of dollars can grow and grow and grow, while at the same time the supply of goods and services can remain the same, if not shrink. This creates consumer price inflation in the United States, while at the same time, outside of the United States, the demand for dollars can be far greater than the supply. This gives a lot of tailwind to the dollar appreciating against other currencies. The main takeaway from yesterday's video is the Fed nor the government have an effective transfer mechanism to get the funny money they print and spend outside of the US to reduce the demand-supply imbalance. The next step is we have to understand what the knowns are. What I mean by that is it's very safe to assume the US wants to maintain the reserve currency status. But let's think this through. If the dollar is continually going up and up and up against other currencies, just crushing other countries and corporations, potentially creating this huge collapse, when the dust settles, and these countries and corporations finally recover, if they even survive, they look at themselves and they have this dollar PTSD, where they say, we are never going to do that ever again. We painted ourselves into a corner by using the dollar and taking out all this dollar-denominated debt for decades. When you combine that with the fact that because the United States has the reserve currency, it gives them the ability to create all these sanctions because they can leverage the SWIFT system. And whenever they want to crush your economy, they can do so by putting up one of these economic sanctions. So after the crash, assuming it happens because the dollar keeps going up and up and up, and I'm not saying that it's definitely going to happen, I'm just walking through a thought experiment so you can determine the probabilities on your own. But if this happens after the crash, these corporations and countries are going to have this dollar PTSD. They're going to want nothing to do with it whatsoever. They're going to be looking for an alternative system. Obviously, that's not what the United States wants. So it's in their best interest to try to manage the dollar from going too high and creating this dollar PTSD. And I know a lot of people are saying, George, yeah, I get what you're saying, but at the end of the day, the United States has the largest military. And since we have this huge military, we can just force people to use dollars. And I don't like it, but, well, that's just the way it is. But what these people aren't considering is the fact that now the military sources a lot of their supplies from countries outside of the United States, countries such as China. So how does that work when the United States has to go to war with China because they want to force them to use dollars to purchase their oil, but the Chinese make everything the United States needs to actually go to war? Doesn't really work out. Another thing that people don't consider is if we get this inflation like we had in the 1970s, it's not like the United States just can print up as much funny money as they want to fund the military, because it would exacerbate the problem of inflation in the domestic economy. For those of you who are alive in the 1970s, just think what would have happened if we would have printed up billions and trillions of dollars to go to war with a country. That would have made the inflation in the United States absolutely unbearable, unpalatable, and it most likely would have prevented the politicians from going to war in the first place. And you may be saying to yourself, yeah, George, I get what you're saying, but the whole reason the United States is in this situation, you said, is because the dollar is too high. So how could we have the 1970s? It goes back to understanding there's two completely separate markets and economies for the dollar. As an example, let's look at a couple charts. Editor, go ahead and throw up a chart of inflation in the 1970s. We know that it went up substantially, but now let's look at a chart of the DXY from 1973 to 1979. You see that it did go down, but not that much. Nowhere near the rate of inflation. And another example I'd like to use is from 2012 to 2020. We know the CPI is understated, and even an understated CPI shows that it's gone up and up and up, while at the same time the dollar has appreciated against a basket of other currencies by over 25%. So these things that seem like they happen at the same time, meaning if there's inflation, the dollar has to be going down, it doesn't always work that way. In fact, it very rarely does. There's really not a correlation between domestic inflation and the value of the dollar outside of the United States. So the next question becomes, if the military isn't an option for managing the dollar going too high, what is? What do they do? This brings us to what I am calling the code red option. To understand this further, let's go right to the Fed's website. The Federal Reserve and the U.S. Treasury may intervene in the FX market when required to counter disorderly, quote unquote, market conditions. After the breakdown of the Bretton Woods system in 1971, the United States monetary authorities, the Fed and the Treasury, used FX intervention both to reduce excess exchange rate volatility and to signal the views of the United States that the exchange rate did not reflect fundamental economic conditions. So much for free market capitalism. However, since 1996, the U.S. has only intervened on 3 separate occasions. At least that's what they're willing to admit to. Including a purchase of Japanese yen in June 1998, a purchase of euros in September 2000, and a sale of Japanese yen in March 2011. Interventions at the direction of FOMC or the Treasury are executed by the New York Fed. When a decision is made to support the dollar's value against another currency, the New York Fed's open market trading desk buys dollars and sells the foreign currency. That is if they have the foreign currency to sell. More on that later. Conversely, to reduce the value of the dollar, it sells dollars and buys the foreign currency. So what the Fed can do is print funny money, go into the FX market. They can buy other currencies with the dollars that have just been created. Well, of course, this reduces the supply of other currencies. It increases the supply of dollars, and therefore the dollar depreciates. But let's think this through further. It's not exactly a panacea. In fact, it's far, far from it. So we know that the Fed has the power to really move markets just by saying they're going to do something. As an example, they say they're going to come out and buy corporate bonds. And before they even buy them, the corporate bond market goes through the roof. So if the Fed did the same thing for the dollar, coming out and saying that they're going to be doing these open market operations, let's call it, where they're printing up all of these dollars going into the FX market, the market is going to front run that before they even get the chance to print the funny money. That takes us over to a doom vortex for the dollar. So going over here, we've got the Fed signals the fact that they're going to be going into the FX market. That drops the dollar. The market responds by selling all of their dollar-denominated assets, taking the dollar down even further. The Fed loses control of propping up the dollar. So now they've gone from a situation where the dollar's too high to now it's too low and just plummeting. Normally what would happen is the central bank would come up and try to prop up the currency. How do they do this? The complete reverse of what they did to bring it down in the first place. So instead of printing dollars to buy other currencies, they'd take other currencies to buy dollars out of the FX market. But this isn't an option for the Fed. That's right. the almighty, powerful Fed doesn't have any FX reserves. Editor, go ahead and throw up the chart from the Visual Capitalist. You'll see that many countries have hundreds of billions of dollars, if not trillions, in FX reserves. The United States only has 44 billion. That's 44 billion with a B. Colombia, the country I'm in right now, has more FX reserves than the United States. The bottom line is that is a drop in the bucket compared to the trillions and trillions of dollars that exist in and outside of the United States. There is no way they have any ammunition to defend the currency. The market sees this, responds in the exact same way by selling all of their dollars, all of their dollar-denominated assets, which turns into this feedback loop where the dollar just goes lower and lower and lower. And of course, if the dollar is collapsing, the next step is the loss of the reserve currency status. And there's absolutely nothing the government or the Fed could do about it. So the main takeaways are the dollar has a lot of tailwind that could drive it up and up and up outside of the United States, giving the countries and entities this PTSD, dollar PTSD. And the US doesn't want this at all. They want to try to manage from keeping the dollar going too high because they want to retain the reserve currency status, but they really don't have a way to do it. The only way is this code red method we talked about, where they print up funny money, go into the FX market to buy other currencies. The problem with that is, although they're trying to avoid the dollar going too high, so they lose the reserve currency status, just by implying they're going to go into the FX markets, that could drop the dollar too low, going into a dollar doom vortex where the dollar keeps going down and down and down, also losing the reserve currency status. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.